Kitco News special coverage of the New Orleans Investment Conference is brought to you by Uranium Energy Corp., Uranium Royalty, Gold Mining, and Gold Royalty Corp.
Hello, I'm Michelle Makori, and this is Kitco News, coming to you from the New Orleans Investment Conference, now in its 47th consecutive year. And joining me now is Peter Boockvar. Peter is the Chief Investment Officer at Bleakley Advisory Group, an $8 billion wealth management firm. Peter is also the editor of the book report. Very good to have you with us, Peter.
Great to be here. Thank you.
Peter, Paul Tudor Jones, billionaire hedge fund manager, the latest to sound the alarm on inflation, saying, and I quote, "It is probably the single biggest threat, certainly to financial markets and to society just in general." We also heard recently from longtime activist billionaire investor Carl Icahn saying the same thing, that there will be a crisis the way we're going, driven by inflation caused by the unprecedented money printing. Now, you were here, and in your presentation last year, you said that inflation was inevitable. Your presentation was, in fact, entitled, "Inflation is Coming." In June this year, you gave one titled, "Inflation is Here." So, Peter, where are we now regarding inflation and the global macroeconomic picture?
So my presentation in New Orleans this week is inflation is not transitory. And I think that that is right now the most important thing in determining the direction of the economy and markets when looking out over the next couple of years. Am I right that it's not transitory, or am I going to be wrong and somehow this is all going to get cleared up and we'll be back to the pre-COVID path of inflation? I'm pretty confident that I'm going to be right, and that inflation is going to remain more sticky and more sustainable than those in the transitory camp believe.
How sticky and how sustainable and how consequential would that be?
So the last CPI number on a headline basis rose 5.4% year over year. And this is before capturing what is now happening in the apartment rental market, which is 30% of CPI, 40% of the core, where rental prices have really accelerated this year. That, I think, will now start to show up in CPI in the back half of this year. And I don't know whether CPI is going to 6% or north of that, but even when it calms down, maybe next year or the year after, I don't expect a reversion back to pre-COVID levels. And I think that's what's most important here. Also, when you analyze inflation, it's not one or the other, black or white, up or down. There are two components of inflation: services and goods prices. There's no such thing as transitory services inflation. Services inflation in the 20 years leading into COVID has averaged about 2.8% a year. It's goods that have been basically flat, showing no price gains, because that's a technology, production efficiency, and so on. But now you're marrying goods price inflation on a cyclical basis, plus back to trend on services inflation, and I'll argue that it's going to go even faster than it's been. And it's going to be a couple of years of higher than inflation than people think. And the bigger issue is that this is not just a Kitco discussion or Wall Street discussion. This has major Main Street implications. The average person is feeling it in their wallet and pocketbook.
Well, when we say inflation, we have groups that are talking about hyperinflation. It looks as though the economy is heading in a stagflationary direction as we see global growth start to wind down or not be as strong as initially expected, certainly according to the latest IMF report. How devastating, though, is the inflation of which you speak? Is it something that is manageable, or is it sort of the end of the world triggering a doomsday scenario type of inflation, as we're hearing in some of the other presentations here at this conference?
Right now, it's just the stagflationary situation that's slowing economic growth. So the Atlanta Fed, which has this GDP now mechanism where they, throughout a quarter, predict what it eventually could end up being, 2 months ago, they were predicting 6% GDP growth for the third quarter. Yesterday, they lowered that to 0.5%. Now, it had been falling gradually over the last couple months, but their last read was up 0.5%. So essentially, they're saying, if they're right, the economy flatlines in the third quarter. And that's all because of this inflation. It's problems on the supply side, where obviously factories are shutting down because they can't find enough parts, but also the inflation is impacting consumer spending. That most of, or more than the when I say more, personal spending is being eaten up by higher inflation. So last Friday, we saw retail sales. Inflation is running faster than the growth in spending. So real spending is actually falling. So the two of those combined is why we're seeing this slowdown in the economy. To me, that's the definition of stagflation.
Right. And now we have this energy crisis, which is also exacerbating matters, as well as, to your point, the supply chain crisis, which is also going to inevitably continue to increase the price of goods.
Right.
So, and not all of these factors are within the Fed's control, but what can the Fed do about it? Is it too late, or is there some kind of Fed action that can salvage the situation at this point?
Well, the Fed can't print more semiconductors.
Sure, yes.
They can't print more oil and gas. But what monetary policy does, instead of encouraging the supply side, they're trying to push the demand side. And we're seeing that. We've seen that over the past couple of years, this aggressive push to convince people to borrow money to buy a car, go borrow money to buy a home. And what they've done is that they've pushed demand to such an extent,
sure,
with the help of fiscal policy,
right,
that now you have a problem with supply, and you have the ultimate definition of inflation of too much money chasing too few goods.
But where we are right now, in this scenario where inflation is proving to be not transitory, what do you expect the Fed to do?
So the Fed initially will follow through with what they've told us they want to do. On November 3rd, they're going to announce that they are now going to initiate tapering. Now, whether that starts November 15th, December 1st, December 15th, I don't know, but it's about to begin. And if it was up to them, they would carry that out over the next 7-8 months without any market accidents, which typically there's an accident in the markets when the Fed
tantrum to be expected.
Tightens, yes. Yeah. And then they'll talk about raising interest rates. But that's how far behind the curve the Fed is that you have the most intense inflationary pressure since the 1970s. And the Fed's going to go 7 months of tapering, and rates are still going to be at zero. So not only that, other central banks are tightening at the same time. The Bank of England may be raising interest rates in November. We've seen interest rate hikes out of developed economies like Russia and Brazil. We recently saw some monetary tightening in Singapore. We saw a rate hike out of South Korea a few months ago. The ECB has even cut back slightly on their QE. So just as we saw in March of 2020, another round of global easing, we are now on the cusp of global tightening. And however glacial, however slow that goes, that's going to have major repercussions for both markets and the economy and inflation, depending on whether they can get ahead of this or not.
So what is the best way as an investor to now position oneself going forward?
So I always like to say that inflation valuations don't matter until they do. You know, it's okay paying whatever multiple you want when inflation is low, when central banks are easy. But once that begins to change, once inflation is part of the equation, once central banks start to tighten, then valuations all of a sudden matter. Right. So I'd rather be in more value-added parts of the market, cheaper stocks, whether it's international markets that are much cheaper than the US. I'm still pretty bullish on commodities, particularly energy, uranium, very bullish on gold and silver. And I think that is a way of sort of maneuvering through this. Now, there are going to be companies that are going to be okay in this environment, those that have pricing power, but those that are going to have margin squeezes because they're paying up for labor, they're paying up for other costs that they can't pass on, you know, that's going to be a problem for those names. And getting back to the valuation standpoint, if all of a sudden PE multiples contract because central banks are tightening in response to inflation, you know, that will obviously affect those companies that have the bigger PEs.
Am I hearing you say that the tech sector then is potentially in jeopardy, or certain parts of the tech sector is likely to be the hardest hit here? Which sector would you get out of first, shall we say?
So from a business perspective, yes, Apple, to use them as an example, they have now supply issues in getting enough parts to finish their phones. So that's a direct impact. But generally speaking, I think more the risk to Apple is, are they going to see faster growth, and what's their multiple going to be? Because in a contracting multiple world, if Apple's PE multiple goes from 30 to 20, without any change in their business, that's a 33% decline in their stock. Now, I'm not saying that's going to happen. I'm just saying that a lot of these expensive stocks become more vulnerable in a tightening inflationary type of environment where PEs contract rather than expand.
But do you see a big market crash? Do you see an across the board 10% drop?
Well, 10% is kid gloves, historically speaking. Usually we get a 10% correction every single year. Where this goes, I don't know. I don't want to say. Our clients are long. We hope that doesn't happen, but I have to be cognizant of the fact that when you look back since 2010, outside of COVID, outside of the yuan devaluation in August 2015, every notable market correction coincided with the end of QE, the tapering of QE, or interest rate hikes. So I'm not going to be delusional and think, oh yeah, the Fed and other central banks are going to tighten and there's not going to be a problem.
Okay, so back to how we best position ourselves to deal with this problem. You mentioned gold, which, despite all the economic fundamentals indicating that there should be a rally, has been stubbornly resisting going past the 1800 level. What's keeping gold back?
So, for context, you look at silver was up 42% last year, gold was up about 25%. I think what has inhibited those two perfect inflation hedges relative to all these other commodities that have gone through the roof is this knee-jerk reaction of, okay, rates are moving higher, the Fed's going to tighten, the dollar has bounced, let me sell gold and silver. That said, now that the tapering is now here, and also the belief that, oh yeah, transitory inflation, yeah, I believe that. In fact, Bank of America had a survey of investors, and still about 2/3 of investors still think it's transitory. Well, I think as the days go on and we see more numbers, people are realizing, it's not so temporary, and that rates and gold can go up at the same time, as long as inflation is going up at the same time, because that means real rates are going to remain firmly negative. So I'm hoping that what we've seen over the past month or two of the market pricing in the Fed tightening is sort of the bottom in gold and silver. Gold and silver bottomed in December 2015, just as the Fed started raising interest rates for the first time in 7 years. Gold went up with interest rates in the 1970s. The Fed funds rate in the mid-2000s went from 1 to 5.25, and gold doubled. That now is the time for those two things to start to catch up to this whole inflation trade and everything else in the commodity space.
Do you have an outlook for gold for the next year?
Yes, higher.
Higher.
Silver as well.
I want to get a little bit more specific than that, Peter.
If you inflation adjust gold for its 1980 high, you can go to 2,500. You can overshoot to 3,000 plus.
Okay.
Silver, if you just look at a 60 times ratio, can get back to its highs of 50 plus. And name me one asset that's down 50% from its record high. I can't really think of many other than silver.
Now, this is your forecast with the environment as it is. And we mentioned the idea of fiscal stimulus because DC somehow is not getting the picture that we are in a pretty precarious state when it comes to the fragility of the economy. And we're expecting even further stimulus if the Biden administration and the Democrats have their way. They still want to pass an infrastructure bill. They still want to pass a reconciliation bill. Most likely some version of some bipartisan infrastructure bill will get passed, which will either inject about 1.5 trillion best case or over 3 trillion into the economy. What happens then?
So we already know, before we even get to that round of fiscal spending, that the fiscal spending that they put in place in March, before that in December, of multiple trillions, contributed to the inflation picture that we're seeing now in terms of stimulating demand, financed and monetized by the Fed. Now, this next round of spending on physical infrastructure and whatever social infrastructure they want to do is going to be spread out over 5, 7, 10 years. So it's not necessarily going to be all coming in at once, but getting back to the same point of just throwing so much money in trying to stimulate things when there's not enough supply, there's a problem. I mean, okay, so we want to fill in potholes in roads, and we want to repair a bridge or refurbish an airport. Well, good luck finding the people to do that. How long is it going to take to actually plan and permit for that? And God knows what the cost of the materials are going to be. So yes, it's going to take some time. Yes, they're throwing in a lot of money. And yes, it's going to just exaggerate this inflation story that we currently have.
But exaggerate to what end? Because in order to pay for the stimulus, the Biden administration wants to raise taxes, both on corporations and on individuals. So if you have the scenario where you have inflation at levels that we haven't seen in 40 years, combined with even further stimulus on top of the unprecedented fiscal and monetary stimulus, combined with this idea of a global corporate minimum tax rate, which may happen, combined with further regulation, combined with further taxes on individuals. Paint that picture for me, Peter. What does that look like then?
Well, you can just exaggerate the stagflationary situation where the economy is going to slow because of these tax increases. All this spending, we're not going to get any bang for the buck of note. In fact, the multiplier even on hard infrastructure is less than 1. So yeah, it's just going to embed ourselves further into a stagflationary environment that completely handcuffs the ability of the central bank to meet that or sort of try to offset that. And if anything, they're just going to exaggerate it themselves.
So is there a top 3 trade moves that you can advise?
I really can't find anything more compelling than gold and silver itself and the miners. The miners are very cheap. They're not getting any respect. A lot of the big ones are paying healthy dividends, trading at very low multiples relative to cash flow. When we think about the good mining companies that have all-in sustainable cost of $800, even $900, and they can sell gold at $1,800, and that's a pretty large profit margin that these companies haven't had in a while. They're much better run, and if I am right on the price going higher, while those costs may go up because they're feeling the same sort of cost pressures that everyone else is, the price of gold will be going up much faster, and those profit margins can expand even further.
But in this stagflationary environment, do you see the industrial use of silver take a hit, for example, and how would that impact the demand for miners and for the physical metal itself?
Well, with silver going into solar panels, going into batteries, electric vehicles, I think that the secular trend in that demand in electronics and anything tech is pretty unstoppable.
Does the chip supply shortage, which is used in a lot of the same electronic devices that silver is used for, impact the industrial demand for silver to such a degree that would impact your prognosis on buying silver and silver miners?
It could. I mean, half the demand for silver is industrial. About half of the rest is monetary and coins, and the rest jewelry and tableware. So yeah, it could have some effect, but the action in silver doesn't necessarily trade off the industrial uses. It really trades off gold, real rates, the dollar, and you can just see that relationship over the past year. So I think if gold gets going for the reasons I stated, silver is going to follow gold.
One of the things that have potentially held gold back is digital gold, Bitcoin, which hit an all-time high today. Do you see that continuing to take away from gold's luster a little bit?
Sentiment always follows price. So yeah, when Bitcoin is going to new highs, that will garner all the attention. Once gold starts going up, that will then get some attention as well. And I don't look at gold or Bitcoin as an all or one or the other.
Right.
They can very much complement each other. As a percent of total financial assets, gold and Bitcoin are minuscule. There's room for them both. And I think that the bulls on Bitcoin are bullish for the same reasons that the bulls on gold currently have.
Yeah.
Inflation, money printing, so on and so on. So it doesn't necessarily have to be one or the other. And I think that it's quite a thing to think that something that's been around for 13 years is going to replace something that has 5,000 years of history.
But having said that, are you also bolstering your Bitcoin position? Assuming you have one?
I don't have one.
Okay.
I'm more interested in crypto generally and where this technology is going than whether Bitcoin's at 65,000 or 55,000 or 20,000. I think to me, what's most exciting is crypto generally and how it's shaking up the financial industry. not where the price of Bitcoin is going.
You have no exposure to Bitcoin directly.
No.
And how do you then create exposure to the trend of crypto?
So we're looking at just sort of picks and shovels types of the areas of the business. I don't own Coinbase, but that can be an example of a stock that, yeah, maybe one day I want to own, and others that can benefit from not just picking the price of a coin, because I think crypto, generally speaking, is trying to shake up the world in ways of not just, okay, is Bitcoin going up and down? I mean, there are plenty of assets with limited supply. Bitcoin's not really the only one outside of gold. I mean, a baseball card that was made in 1970, well, they're not making any more of it. But I'm not hearing that a baseball card from 1970 is all of a sudden going to replace gold. They're all collectibles, finite in nature, where you can't print any more of it.
All right. Well, Peter, thank you so much for sharing your thoughts with us. We know you have a presentation to get to, so we appreciate you joining us here on Kitco News. Thank you so much, Peter Boockvar.
Thank you for having me.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Uranium Energy Corp, Uranium Royalty, Gold Mining and Gold Royalty Corp,